Hey everybody, this is Brant, and it's been about 3 weeks since my last full video, which was called Cracks on October 29th. Obviously, a lot has happened since then. We've had this huge rally in the S&P 500, which has gained 10.75%. I've labeled this rally for my subscribers the dash for trash. You'll find out why as we go through this video. But I think context is really important, so I want to play a couple clips from that October 29th video, and then we'll move forward. The first one is dealing with these head and shoulder tops and their measured moves being met. So like S&P 500 at 4,100. So here we go. Here's the first clip.
The head and shoulders top is broken. Here's that when I said, is the market too bearish? So we are within 0.1% of the measured move. And of course, it's not just the S&P, but the Dow Jones Industrial Average. And by the way, this vertical line is the measured move. Here's small cap IWM, and that's the measured move. So from that head and shoulders top, it's hit that measured move and it's exceeded it.
Okay, so you get the drift. A lot of times when these measured moves are hit, the next thing that happens is either you have a consolidation generally, but with a head and shoulders top like this and basically almost 3 months of going down to that measured move, a lot of times you'll get like a dead cat bounce or something like that. This was a lot stronger than what I anticipated, but still that's what happens when measured moves are hit. I want to show you real quick a post, a subscriber post for my members from September 5th. So we're talking about, really early back here before we've even got a broken head and shoulders top. But this is September 5th, long before these tops broken, targets are hit, basically forecasting the potential for this kind of a seasonal rally. So let's take a look at that post real quick. And here it is from September 5th's daily wrap for subscribers. And this was September 5th again. Like I said, we hadn't even gotten into that point where we're talking about the head and shoulders tops being broken. So if we go through it real quick, I say the first red arrow represents price moving back down to the neckline right over here. Then we typically get like a little brief pause or a bounce, and then we move down to the measured move, which is 4,100 for the S&P, which we got over here, at which point the trend is over, right? So we've hit the measured move. It could be over on the move to the neckline. From there, we get into a seasonably favorable time of the year. This is kind of like the Santa Claus rally, election Santa Claus rally, etc. The economy is likely weakening more by then, and chatter about the Fed cutting rates more aggressive in 2024, which is actually true at this point now. So that was a pretty good forecast, or sooner than expected. So basically what would happen was, with a weaker economy, weaker forecasts and stuff, yields go lower and stocks bounce from that into the seasonal pattern, which is this rally, which is what we just saw in November, and then eventually we head back down. So this is kind of what I was talking about. You can pause it and read it if you want. And let's move on to the next little excerpt from the October 29th video.
As far as this channel goes, there's a concept that I have kind of named myself, and I call it a channel buster. So when we get a really deep kind of break of a channel like this, sometimes it acts like a rubber band and it slingshots prices back up this way. So imagine you're a short seller and you're seeing this channel break down. You get really excited. Okay, we're getting ready for a crash because this channel is breaking down, and then prices move back into it. Then those shorts cover and they kind of add upside momentum. You get the slingshot.
Okay, so we were seeing the setup of a channel buster and a rebound from that, like I just explained. So the next clip is talking about how bearish sentiment was down here. So let's take a look at that clip from the October 29th video.
Breadth oscillators are really deeply oversold right now. If we look at sentiment, the last time we saw sentiment this low in extreme fear was early October back over here. It was at 18. I think it's at like 24, 25 right now. So sentiment is getting really bearish again. And the reason that that's important is because when sentiment gets to extremes, it's often a contrarian signal. So our extreme greed over here was actually when the market topped out at that head and shoulders top and actually turned lower. So a lot of times when you get to these real extreme sentiment readings are actually contrarian for the market.
Okay, so hopefully you're picking up a little bit on what I was laying down there. At that point, we had met the measured moves. Sentiment was getting extremely bearish, and breadth oscillators extremely bearish. And we were at a point where the market was ready to do something, whether that be a small consolidation or a kind of like rebound rally or oversold rally. The next clip is, I think, one of the more important ones, and that's the leading market signals. So rates and the dollar have been extremely reliable as far as leading market signals. This is a quick clip because right towards the end of October, going into November, they were changing for the better, for the positive, for the bullish for the market. So let's take a look at that clip again from the October 29th cracks video.
And remember when I told you that gold and stocks have had a very strong inverse correlation with yields. But if we take a little bit closer look, like on this 30-minute chart, that it's actually higher yields that are leading the market lower. But if we look over here, we can see kind of we're not making higher highs in yields right now. So the Nasdaq has pretty much caught down to the medium-term correlation. Longer term, it has a lot more to go. Here I have the S&P 500 in that sub-intermediate downtrend channel, and I have high yield credit HYG. At this point, we can already see high yield credit leading the market lower over here. Around 4,200, the two kind of caught down to each other, and now high yield credit is starting to positively diverge a little bit too.
So there I'm talking about another thing, which are the leading market signals, which had been leading the market lower at that point. And as we were just coming into November, they were starting to turn positive. So one final thing, and that's 3C and the positive change in character there. And again, this is an excerpt from the October 29th cracks video.
We always look for changes in character because changes in character are what precede changes in trend. The market very rarely just changes trend without giving you some kind of a warning, a change in character. That's what we look for. Here you can see QQQ, and again 3C over here is either leading price lower or it's confirming lower until we get into the end of the week over here. Now, sometimes these kind of positive divergences on these really short-term time frames just lead to like a consolidation, like a bear flag or something like that. But I would give the award for most improved this week to QQQ, and it was just the last couple of days of the week.
Okay, so the point of this, again, is another change in character where you can see 3C is leading prices lower right into the end of October here. We get a relative positive divergence. 3C is not making lower lows. Now 3C is making higher lows and higher highs. It's positively diverging. So we have a lot of things converging coming into November or very, very late October that are leaning much more bullish than what we had seen the prior 3 months. So what you're looking at is the S&P 500 in the green and red candlesticks and my most shorted index in white, right? So by October 27th, my most shorted index, the list of the most shorted stocks, had hit the lowest level since the 2018 crash, that 20% crash. This is the COVID crash. I mean, the shorts were just pressing and pressing, especially since this head and shoulders top right here formed, the very top of it, that failure at 2600, oh, I'm sorry, 4600 with the key reversal day. So a lot of short sellers just non-stop. So huge potential there for a short squeeze. You can see again, October 27th. I've since learned that at this point, by October 27th, hedge funds were record short. They had never been shorter, so that makes sense with what I'm seeing on this chart. But this is what we saw, before I got that data confirmed. So by the time we're down here, you have all these factors lining up. Oversold, over bearish, hedge funds, the most short they've been. Changes in character in 3C that were turning more positive. Leading market signals, which have been by far the most effective signal you can get the last 2 years, okay, and that's rates and the dollar, and they trade inversely right now to the S&P 500. So we have the factors, we have the measured moves met, right? So something's going to happen there. The deep oversold, contrarian indications, the sentiment with extreme bearishness, again, contrarian signal. The shorts that were non-stop hedge funds, record shorts, and we also had the favorable seasonal factor, which is something I had written about, way back in early September, because I was looking at where we would probably hit the measured move on this head and shoulders and say, hey, we're going to be pretty close to that Santa Claus rally, favorable seasonal factors for the market. Finally, one other huge aspect was we just came out of earnings, and as we were moving into that week, the corporate buyback blackout window had fully reopened. Corporates were fully able to go in and buy, and they're indiscriminate buyers. They don't care at what the price is, they buy. If you listen to that full October video, I thought maybe we had one more day of downside, so a couple averages that were really close to meeting their downside measured moves of these head and shoulders tops met them. But what changed was that very next Monday, the Treasury refunding statement came out, and it was much better than feared. That sent yields lower, that sent stocks higher, and then that Wednesday we had the FOMC, which was taken as really dovish because Powell said that the market was doing all of the financial tightening for it because long-term yields were rising, credit spreads were blowing out, all that. And basically what the stock market took away from Powell's comments was, we're done hiking rates. Okay, we knew this back in June. The bond market knew this back in June. The stock market was just picking up on it. So it had a bunch of things right in here that were very favorable that first week, that first Monday, then that Wednesday. I think Powell made a big mistake. I don't think he meant to, but financial conditions in November during this rally, because when stocks rally, that helps loosen financial conditions. When yields come down, that loosens financial conditions. Financial conditions have loosened by 150 basis points. So that's like 25 basis points Fed rate cuts, okay? Or 1.5% of rate cuts from the Fed. So what Powell was applauding, that the market was tightening financial conditions, actually backfired, and it loosened them, which would effectively make the Fed funds rate 1.5% lower. That's not what they want. So I'm sure we're going to hear some pushback from the Fed on that at some point. But it goes without being said that looser financial conditions are like gasoline on this rally. This is the next chart I'm going to show you. Remember my most shorted index. That's what we're looking at again. And IWM. Typically, the most shorted index and IWM, the Russell 2000 stocks, move really closely together, really closely. And this is why I say like the dash for trash, because, you know, small caps just have not been doing well this year compared to everything else. But as of November 2nd, look at the size of this short squeeze. It is unbelievable. Definitely by far the largest short squeeze I've seen this year. So shorts, remember hedge funds were record short coming into this down here. My most shorted index was the lowest since 2018. Those guys got their faces ripped off. Now here's the really silly thing. Again, we're looking at the most shorted index and IWM. Here's that first massive short squeeze. Can you believe this? What did they do? They went short again, and shorter than they were back here when the squeeze started. So they gave the market ammunition for another huge short squeeze. I was telling my subscribers, look, this is no time to be shorting the market. This is a time to be patient, right? Because there were no market signals suggesting that, hey, you know, that you should be short. Just because the market's gone up a lot doesn't mean you should short it. But that's exactly what they did over here where I've highlighted it in red, and they primed themselves again to be short squeezed. So they got their faces ripped off twice in 2 weeks. If we look at this rally for the S&P 500, let me just zoom in a little bit. Basically what you have is the first short squeeze here, right? And then a consolidation. Those shorts were jumping right back in, and then here we get the second short squeeze. The thing that kind of bothered me about what happened in between were the consolidations were not clearly bullish. They're kind of either drifting a little bit higher. It just showed to me what I said at the time was I don't think that institutional money is behind this move whatsoever. Because when they are, you tend to see these bullish consolidations, which we really didn't. We saw consolidations, but none of them could be labeled as, okay, well, this is a bullish flag or this is a bullish ascending triangle. They were just kind of, in some cases, even broadening patterns. But in any case, those are your two big short squeezes that move this market. To give you an example of that, this is the Dow. So here is the 30th. This is where that whole rally started with the Treasury refunding, and then we had the Fed on the Wednesday. In any case, big short squeeze here, but this consolidation over here, sorry about the funky lines, is actually a broadening pattern. This is not a bullish consolidation in any way. It's not too bad as a small consolidation, but it's actually known as a broadening top when you see them in these really big formations. And basically what it is a chaotic environment that's lacking intelligent sponsorship and leadership, right? Which turns out to be the case because institutional money was not behind this move. A lot of short squeeze was behind this move. And although a short covering is buying, they have to buy to cover their short, they're not longs. They're not sitting there buying to hold a stock. They're trying to get out of a short position, then they're done with the transaction. Okay, so it's not like a bull who's buying and is holding. So now that some of the dust is cleared and we're getting an idea of just exactly what was behind this move, I'm going to show you a few things. So Bank of America, this is the week, not last week, not Thanksgiving week, the week prior. You can see 11.6 to 11.10. So this is what Bank of America's research division had to say, their global research. This week, from 11.6 to 11.10, they saw the largest weekly buyback from corporates in their set of data history, which goes back to 2010. Over here, you can see last week, the 4-week moving average. Corporates buying. Those are corporate stock buybacks. Okay, you can see hedge funds, teeny bit of buying. You can see institutional money, like I said, was not involved. They were selling. Retail was selling. The week after, which was last week, and you can see the date here, November 13th through November 17th. What Bank of America had to say this week saw the second largest weekly corporate buyback in history, going back to 2010, their data set, and it was only surpassed by the prior week. Again, you can see corporate buybacks were huge as that blackout window opened. You can see hedge funds over here were doing some selling, retail doing some selling. Again, the whole time, institutional money not involved. They were selling, not buying. This is what I was saying to my members throughout most of November, especially when we looked at those consolidations. It's like, this is not what institutional money backing looks like. And as you can see again on this chart, everyone except for the corporations were net sellers on this week. Okay, still, they're price indiscriminate when they buy. So it's not like they're waiting for a pullback to buy. They have a buyback, they buy back. Even if the price is higher, that drives price higher. So that's in addition to the short squeezes and all that other stuff. This next chart, again, just puts a little finer point on it. Again, it's from Bank of America's global research. Corporate client buybacks as a percentage of market cap is above seasonal trend for the second time since May, and this week's inflow is the second largest in our data history. That was this one. The prior was the largest in the data history. So you can see this is the average for the seasonal buybacks in this kind of light blue line, and these were those 2 weeks. So huge corporate buybacks in November. There is one other group of indiscriminate buyers that are trend followers. They're called CTAs, Commodity Trade Advisors. Basically, forget about the whole commodity thing. They are trend followers. So the market hits a certain level, they'll dump 25% of their holdings. If it goes down a little bit more, they'll dump 50%. Then they'll go 100% net short, right? And if the market goes up, they start buying back. They can go all the way back up to 100% net long. So the CTAs have no choice but to buy. They are not discretionary at all. So they don't say, well, you know, the data this week, the employment data wasn't good, we're not going to buy. They are a rules-based system. So let's look at the CTAs, what they did. Hopefully you can catch all of this chart, but this is CTA positioning, okay? And this is from Goldman Sachs Prime Desk. And what Goldman Sachs Mike Washington had to say was, over the last 10 days, CTAs have bought nearly $70 billion of U.S. equities. This is the largest 10-day buying we have on record. So when he's talking about the 10-day largest buying spree on record. There it is right there. CTA's going super net long in addition to these corporate buybacks. And the major short squeeze twice. According to Washington, who's done this analysis, his opinion now is that CTAs are just as likely to go short as they are to chase the market higher at this point, because they get to a point where they're 100% net long. And after that, they can't go any further net long. So the gist is, between the setup coming into November, between the corporate buybacks at record, CTA record buying, one of the most brutal hedge fund short squeezes in years, and a lot of helpfulness from weakness in yields in the dollar, you can see why this has been a really spectacular rally in November. 10.75% for the S&P in November. That's just a monster move. I do want to follow up on the prior video from late October, cracks, which was cracks in the mega caps, and why that is important simply is because the mega caps have been the only game in town, the only leadership for the market in all of 2023. And when I say mega caps, it's mostly been the Magnificent Seven. So 7 big mega caps basically have led all the market's gains in 2023. The reason I called this the dash for trash was because of the most beaten up, the most hated, the most shorted stocks were the ones that were squeezed so much higher. That's why I call this rally the dash for trash. But interestingly, in this rally, if you look at the Nasdaq 100, which is a modified cap-weighted index, which means those 7 mega caps are the most influential stocks in the Nasdaq 100. And if you look at the Nasdaq 100 equal weight index, there's very little difference between them this month. That's something pretty new for this year, which means the mega caps are not contributing the same degree of leadership that they had been, which was the point at the end of October of this video, that we were seeing cracks in the mega caps. And we've seen them before. In July, we saw some distribution in some of the mega caps and saw it again. And then in October, and then we got confirmation in October. So let's look at a few of the popular ones, and let's start with NVIDIA. So remember when I talked about mega caps rotating in January of 2023? We saw signs of it late December when they were really being sold hard for tax loss selling, but 3C was showing that being accumulated. In July, I identified this 475 level as troublesome for NVIDIA. So even though we've had a really nice month for NVIDIA, we're pretty much still going lateral right around that 475 level. If we zoom in a little bit to November's rally, what do you see? I see heavy volume down here. I see this rally on lighter volume, and then I see some big heavy selling volume just the last couple of days, this last week. And this is in a seasonally light volume period with the Thanksgiving holiday week. We jump to NVIDIA's 3C chart. This is 3C, right? So if 3C is acting normally and confirming, it will move up like this. It will make higher highs, higher lows with price. You can see over here as we approach that 475 level, a very negative divergence, which sent NVIDIA lower. The November rally, here's November 1st right here. You can see good confirmation up until about mid-month when we get into that 475 level again. And NVIDIA on the 3C chart is not looking great. Now we're looking at probably the most important stock in the market, Apple. And Apple was the first stock that we saw some distribution in mid-June, right around this area, right? And then head and shoulder tops start forming. We see trends like this start breaking. So we've had a nice rally in Apple, right, in November, but really it's coming into the same kind of area where we saw distribution in mid-June, right over here. So let's take a look at a few other charts. Here we're looking at Apple's 3C chart, same one as NVIDIA, same time frame, right? Here we are in late October. Here we are in November. We have good confirmation from 3C until what? Recently. Same thing as what we're seeing in NVIDIA. But for Apple, this is in the same area where we were seeing distribution in mid-June. Here is a 2-hour chart of Google, and I talked about Google in that October video, this nice uptrend. Earnings broke down. Here's November. Gaps love to be filled. Look at that. Fills the gap, but it's back testing that uptrend line that had broken down. So Google did what? It basically rallied back up to where it was when earnings came out, filled the gap. And when I look at Google's 3C chart, I'm a little bit less impressed than the others. And the reason why, first, we see a negative divergence over here before earnings. A little bit of confirmation early on, but look right over here, basically the second week of this rally, not getting great confirmation. 3C is trending up, it's tracking up, but it's nowhere near confirming. If you look at where price is here, you look at where price is here, look at where 3C is here compared to that, to me, it just does not look good. And then the other thing is the volume on this rally. Now, granted that we have the holiday week, with Thanksgiving and everything, and volume typically falls off. Volume really didn't fall off that bad until Tuesday, but, through the rest of the week, it's pretty low. Still, let's take a look at the volume on some of these rallies. So here's a daily chart of Google with volume. Here's that earnings gap down, and here's our November rally. I mean, look at the volume on the gap down, and look at the volume on the rally. It's basically kind of declining throughout this entire month of November. If we look at Meta, Facebook, former Facebook, here's our rally in November. Again, big volume down here. But a lot of times big volume, it is bearish, but a lot of times it's seller's capitulation, especially when you get this is almost a hammer. It's pretty close enough. But big volume like that often signifies seller's capitulation. But if we look at the rally, look at the volume just declining. That is not what you want to see in a rally. Apple. Same deal. Here's our rally in November. Check out the volume declining, not bullish. And we'll finish where we started. NVIDIA, here's our rally in November. Not great volume. I mean, it's not completely declining, but it's just not great. And then look at this big volume the last few days over here. Again, that 475 area has been tricky for several months whenever I called it out. So that's a look at what has happened since the last video. Let's see what's happening moving forward. So despite this really big rally, bigger than I expected, I thought maybe we'd come up to here or somewhere in here, but a lot of things conspired, as you can see. But we're in a really interesting spot for the S&P 500, which is this bearish, let me get a different drawing tool here. It is this bearish gap. Let me see if I can get this right. Pretty much, well, you can see it's pretty much close enough. So we're in this bearish gap, okay? This head and shoulders pattern was just suggesting that we'd come down to this measured move. After that, it was like, well, we'll probably see a seasonal rally. And I'll show you what I kind of expected more. But the point is, we are at a very interesting spot with this unfilled bearish gap. A lot of times these act as well, not a lot of times. A lot of times gaps are filled. More often than not, gaps are filled. But I saw this gap. This was right after the key reversal day, which was right here at 4,600, the top of the head and shoulders. So it's an interesting area. I'll show you what I kind of more expected this to be, the seasonal rally, when I talked about it on my subscribers post on September 5th. I figured it would be something a little bit more like the Dow transports, which broke down from this odd shape, head and shoulders, back tested it, more than met the measured move. Here's a bull flag. So this was the only index that had a bullish consolidation in this November between the two short squeezes, transports, and it back tests right into that neckline. That's something more typical that I would expect to see. We can look at IWM. It didn't even make it up there, despite all the short squeezes. So short squeeze, this is not a bullish rally. I mean, it could have been maybe a bear flag, but it was just way too steep. Over here, maybe we have a triangle over here. So if those shorts jump back in, the most shorted index, and they start piling in again, they might spark another short squeeze. We maybe, come up here and hit this level. But small caps really didn't even do as well as I was anticipating for this kind of seasonal rally back in September. From kind of a bigger picture perspective, this puts that whole kind of double top issue back at the forefront, and I'll show you. And what that would be is basically a double top with what was the all-time highs in December of 2021, right? So for a double top, you don't have to have price come all the way up to it. A lot of times price will kind of fail and roll over here. So it's an interesting area because of the gap. It's an interesting area because of the potential of this double top. We'll have to see what happens with that. Let's take a little finer look at the things, but this is just kind of an overall big picture potential double top kind of thing forming. So basically the last 2 trading days of this week, which I don't want to put a whole lot of emphasis on because, you know, you're running skeleton crews at trading desks. A lot of traders just take the whole week off. I don't want to put a whole lot of emphasis on this, but the last 2 days, the last 2 trading days, seeing some changes in character, okay? And the most important ones to me are the market leading signals, which are from the dollar and from rates. So let's take a look real quick. Okay, remember I said the 2 most important drivers of the market right now are rates and the dollar. And the stock market has an inverse correlation to both of them. Rates and the dollar are both reflecting inflation expectations, Fed expectations, and they're going to start to reflect more and more economic expectations. Remember in that September 5th post, I said by the time we get into this period, like 3rd, 4th quarter, we're going to start seeing weaker economic data, which we are, which is going to weigh on yields, right? And it's going to weigh on the dollar. So here's November 1st, where the dollar put in this shooting star. This is November. This whole decline over here is November. That's been very, very helpful for the stock market. Conversely, from July all the way up here, this is where we were getting those head and shoulders tops breaking down. But what's interesting is where the dollar is right now. This is the 200-day moving average, and it is like sitting right along here the last 4 days. Potential leading market signal if it finds support and it starts to move up. The very same way that this weakness over here was leading as a potential, as really a positive leading market signal coming into November for the stock market as we start to roll over. As you can see, November 1st, it's nothing but down. Stocks are nothing but up. The other really important one is the 10-year yield. And this really summer, we got this huge kind of explosion higher in long-term yields, right? I had done, for subscribers, you know the post that I put out about 6.6% on the 10-year, and that would be catastrophic. But as you can see through the summer, as yields are rising, what are stocks doing this whole time? They are falling. But over here, right, we're already getting that little set of lower highs, which was what I was talking about earlier in the video, the excerpt from the last video. Right? And remember, it's an inverse correlation, and we get yields breaking this long-term downtrend. Let me zoom in a little bit closer. What I've been telling my subscribers is if yields recapture this trend line, it is on. Okay, if they recapture 4.6%, the 10-year, or this 4.65% level, the trend line, by that time, I think stocks are already going to have rolled over. We could see a little bit of support right in here around, 4.4 to 4.45%. We did see a little bit of a jump over here on Friday. Thursday, we saw that little bit of a jump in the dollar. So these are very, very early potential leading signals. And in my experience, they generally will, they'll show up and they'll keep developing for about a week before stocks notice them. When stocks notice them finally, as they start to put pressure on stocks, then you see the reversal in stocks. And this is why I've been telling my subscribers the whole time, I would not short this market. This is the time to be patient. This is the time to observe. But I should mention, there's at least 1 to 2 days of some leading signals that we have not had at all, not even once in November. This is especially important because from a longer term strategic perspective, the rally in November, because of all the great things that have propelled it forward, from CTAs to corporates buying back to, the biggest short squeeze in years, and then again, The reason why is if you look at it from a longer term strategic perspective, stocks have outrun their correlation with rates, okay, in November. I'll show you an example of this. So right now you're looking at the Nasdaq 100 futures, okay? This is our rally in November, and you're looking at 10-year Treasury futures, okay? Remember I said that stocks and yields have had a very strong inverse correlation since the Fed started hiking in March of 2022. Bond yields move opposite bond prices, so I just used the 10-year Treasury futures here in white as a proxy, and you can see areas where we get these leading signals. I'll show you a couple real quick. It's a little bit hard to see on this one because it's off the chart, but this divergence here, sending stocks lower. Stocks run up over here. Again, divergence. That is a leading market signal coming from rates, coming from fixed income, right? Little bounce over here in the Nasdaq 100 futures. You can see rates are not confirming. Over here, though, this is the positive divergence I was talking about right there. It's a little bit hard to see on this longer time frame. But what I'm talking about right now is how far Nasdaq 100 futures or the S&P or any of the averages have run compared to where yields are at right now. Yields are barely higher than they were over here, but look how much higher the market is. But they're still kind of trending higher. So we have the strategic signal here, right? We have a problem. But we need the short-term tactical signal, these divergences, these like shorter-term divergences. And if we look at this on a shorter-term time frame, so this is Nasdaq 100 futures and 10-year Treasury futures on a 15-minute chart, you can see good confirmation through most of this rally, through the consolidation periods. This is what I'm talking about that is starting to look like potentially a tactical signal where we get that divergence between Treasury futures and the Nasdaq 100, but it's really an inverse correlation with rates. But since rates move opposite Treasury prices, this is pretty easy to use. This is not a sell signal, in my opinion. This is potentially the start of the first market leading signal. We need it from the dollar yields, and they tend to move together, so they will typically confirm. Like I said, we'll typically see about a week's worth of that before we see a trend change in the market, which actually works out kind of well because most of the time we see trend changes at the start of a new month or the end of a month, just like we saw November, right? As soon as November kicked off, we're off to the races to the upside. I think I have enough time on this. If I roll this back, we can get to the positive divergence, and there it is right there. Okay, so here's the date, which is October 26. Let me pull out a drawing tool, and this is a positive market leading signal, right? You can see the Nasdaq futures are still moving down, but what's happening over here? We're making higher lows, right? That was the positive signal I was talking about from the excerpt of the October 29th video right there. We could see it in high yield credit as well, and we could see it in the dollar. So in my opinion, between CTAs maxed out, they're probably pretty close to 100% long right now. Between the fact that institutional money was never behind this rally, just as I suspected from the way the market was acting, how the consolidations were going, the fact that it was short squeezes driving everything, and we actually saw it in the data from Bank of America. The only buyers that are left right now, and they are serious buyers, are the corporates. Okay, they will be entering their blackout in December again. I can't remember when, but I think it's towards the end of December. These leading market signals from rates and from fixed income and from FX are key. They are the most reliable. Again, like you can see, we have like 1, 2, 3, 4, 5, about a week of a divergence between the point where the market actually realizes, the equity market realizes what's going on. And I've always said this, fixed income, FX, commodities, they're way more sophisticated. The equity market is the dumbest of the markets. So these leading signals from these more sophisticated markets are very valuable. And finally, one other change in character I want to show you is 3C. Okay, so this is the SPY for the S&P 500 3C 1 minute chart. It's the fastest chart, it's the most sensitive, but it's also not the strongest. So it picks up on signals first and early. Unfortunately, as much data as I get from Stock Finder, I can't really scale this well, but what you can see is 3C is moving up with prices over here until we get to about the midpoint of the month. And it's really interesting. We're not seeing the support in 3C over here towards the end of the month, but the trend time frame for this is the 2 minute chart. So it's a stronger chart. It's less sensitive. It doesn't show the really early changes, but this chart has been suggesting that we'll see the divergence migrate over to the 2 minute chart. And the 2 minute chart has confirmed this rally all the way. So here's the 2 minute SPY chart. Here's the end of October. Here's the start of November. What's 3C doing? It's moving with price. It's making higher highs and higher lows with price. It's confirming. Over here, it's not doing a great job of confirming. It's not making like a higher high right here. But this isn't a divergence that I would say, oh my gosh, guys, we got to get in on this. But something all of a sudden started to happen at the end of last week. So this whole rally from the very end of October through all of November thus far has been confirmed until the last few days. Also seeing this in small caps IWM, which have been driven almost exclusively by short covering. I'm going to do this without a marker, but you can see as we come into the end of October, I was even talking about in the end of October, I think IWM is building a small base, right? We could see the positive divergence here as prices are moving lower. That's accumulation. That's lower prices being bought by smart money, right? We get the short squeeze, kind of confirm along a little bump up again on the second short squeeze. And now we have this triangle consolidation. So this is still a bullish price consolidation. It's not the most bullish of the bullish consolidations, but it is still bullish. But notice 3C here is falling off. I would expect to see this on a 1 minute chart because it would be telling us, well, we're just going into a consolidation mode. But on this 2 minute, which has been the trend time frame for November, this is looking a little bit weak. Would I jump in short right now? No, but these are the first couple of signals that we have gotten in all of November that are saying something is changing here. If you are a subscriber of my service, then a lot of people have been asking me, hey, is it time to get short? Is it time to get short? I have been saying consistently, this is on Twitter, so if you're not a subscriber, you can follow some of my stuff on Twitter. I put stuff out there. I just said this was November 8th, by the way. The stock market had the biggest rally of the year last week. Common market sense and my 3C charts say that this is the time for the market to bullishly consolidate, which it started to do over here, except it just went lateral. So it consolidated, but not bullishly. I said, but I'm not seeing that across the averages. Patience and observation are warranted. Okay, October 8th. Again, this is on Twitter. Shorts via my most shorted index got aggressive again last week. Remember I told you big short squeeze and then they shorted it again. They got aggressive last week and they're getting squeezed again today, November 14th. So I have been saying this whole time and I'm still saying to my subscribers, right now, patience is warranted. I wouldn't jump the gun. I would wait for those signals, but finally we are getting the first hints of signals. They are hints at this point. We want to see strong signals. We have the strategic signal set for this market to turn down. We need the tactical signal set. And we're seeing that a little bit in the dollar, a little bit in yields, a little bit in 3C. So let's give it a little bit of time. If you're not a subscriber, I'm telling my subscribers this stuff and more every single day, 5 or 6 posts a day, letting them know exactly what's up. If you're not a subscriber, check me out on Twitter. I do put some stuff on there occasionally, but a lot happens between these videos, as you just saw with this video. So consider subscribing. We're going to be moving to the new website very soon with the Discord room and a lot of new features. And at that point, price is going to go up. But if you subscribe before then at Wolf on Wall Street Trade, you are grandfathered in at the 2008 rate. So I hope you enjoyed this video. I know it was a lot, but I hope it gives you some context of where we've been, where we are, and where we are potentially going. Thanks for staying with me. Have a fantastic week ahead.